So finally, you are getting which here? 8.0? 8.008. Others are getting which here? Someone else has gotten 7.9935. So I'm told it is 8.00. 8.008. Yeah, so they are saying you should get around 8.008. So there is a question on the pilot paper, the one for December 2021. Check a pilot paper, December 2021. There is a question number 4, part B. December 2021. There is a question number 4, part B. Go to page 3. Go to page 3. There is a pilot paper, December 2021, question number 4, part B. There is a question number 4, part B. There is a question number 4, part B. So that question 4, part B on the pilot paper, are we all at that point? So we are checking the question on the pilot paper for the sitting of December 2021, question number 4, part B. It is there on page 3. It is there on page 3. So the question reads that Ranax Limited is planning to invest in an expansion. Is planning to invest in an expansion. So the company has estimated shillings 20 million as the initial investment for the expansion. The company has estimated shillings 20 million as the initial investment for the expansion. Then they went further to say that the plan is expected to generate shillings 5 million annual after-tax cash inflows for the next 5 years. The cost of capital is given as 10%. The cost of capital has been given as 10%. So required Roman letter 1, net present value of the project. The net present value of the project. Roman letter 2, value of the call option to delay. Value of the call option to delay if the risk-free rate is 7% and the standard deviation of the return. The information is not there, you write, it is 30%. And the standard deviation of the returns is 13%. So you add there 30%, it is not there in the question. So that Roman letter 2 should read that the value of the call option to delay if the risk-free rate of return is 7% and the standard deviation of the returns is 13%. So there are some things now you need to get to understand on that part. But before we go there, let us first calculate the NPV. Let us first calculate the net present value. So NPV is supposed to be given by, so first we compute the NPV. We shall first calculate the NPV. We should first of all compute the NPV. So NPV is supposed to be given by the present value of the cash inflows. We minus present value of the cash outflow. NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. So present value of the cash inflows. You simply take the annuity multiplied by the present value interest factor for the annuity. We multiplied by the present value interest factor for the annuity. We have said the cost of capital is what percent? 10% for how many years? Yeah, so the after-tax cash flows are 5 million. So you use the annuity table. Annuity table is the second table. We apply the annuity table, which is the second table, so that we get the present value for that. So in a quadro question, in a quadrant point, 3.79. So when you multiply 18.95. 18.9539. 18.9. Exactly. So we are getting 18.954. So you less the present value of the cash outflow. So that is now meant to be the initial cost. It is meant to be the initial cost, which was 20 million. So when you subtract, now you get the NPV, but that NPV is negative. When you subtract, you will now get NPV. So the NPV is negative, which means you can be able to reject the project. You will be advised to reject the project because NPV is negative. When NPV is negative, you are advised to reject. Sometimes someone can be fair, but when they provide, they will not use the same initial that I'm using. But when you revise that last minute, they will not forget. So sometimes they may provide, but most of the time, when it comes to derivatives, they don't provide. They don't provide. So that is now our Roman letter 1. When it comes to the Roman letter 2, they were asked you to get the value of the call option to be paid. So you remember we talked something about the real options. We talked about real options. Real options, one of the real options is the option to delay. Another real option is option to expand. Another one is option to abandon. There are several of them. So for this one is the option to delay. Option to delay is the same as the value of the call option. So option to delay is the same as the value for the call option. Also, option to expand is also the same as the value of the call option. But if they give you the option to abandon is the same as the value of the put option. All others will be value for the call option. But option to abandon is the value of the put option. Option to abandon, it will be the value of the put option. So some information I want you to know, because the question has not given you P and E. So what normally happens is that when we are calculating the value for the call option under the real options, our P is the same as present value for the cash inflows. Now our P will be the same as the present value for the cash inflows. So for this question, it is 18.954 millions. So your P is meant to be present value for the cash inflows, which now in this case, it is 18.954 millions. Then our exercise price is the same as present value for the cash outflows, which is now meant to be 20 millions. So now that's now the new concept you get from the real option. Under the normal options, they were giving you the exercise price and also the current market price of the stock. But now we are on the real option. When it comes to the real option, your present value for the cash inflows, that's now to be representing our P. Then our present value for the cash outflow is what will represent the exercise price. So now from there, because they wanted you to get the value for the call option, we should now start by calculating D1, then D2. Then after that, we get the value for the call option. After that, we now get the value of the call option. So let us first compute what is meant to be D1. What is meant to be D1. So D1 is supposed to be given by, so D1 is supposed to be given by the natural log, then P over E. Then we add R, then plus a half the variance. Then you also divide by, we come up those digits. Come up now with those digits. So we have said that now to compute our D1, we have said P is the present value for the cash inflows. You remember it was 18.954. Then present value for the cash outflow is the exercise price. Inakuja ngapi? Akwa 20 millions. Then now we add. R is supposed to be the risk-free rate. So risk-free rate is given as which figure? 7% is the same as 0 point. Then we also add the variance. The question gave me the standard deviation of 30%, isn't it? Yeah, so to get the variance, you square that figure like that. The standard deviation was 30%. So you square it in that level. Then our T is the time remaining. This one was for 5 years. It was meant to be 5 years. Then we divide by. So this one is the standard deviation. The question had given the standard deviation. So just use the way it is. Then now we come up with that particular portion. So from the information given, I have said in the explanation that When it is option to delay, it is the value for the call option. Option to abandon, it is the value of the put option. So anything to do with that part, you must use the black codes. There is no option for that. When it comes to the real options, those ones are always the black codes. And now when you want now to compute the value for the put option, you include the put code parity. You include the put code parity. So here this one should give us which figure? 0 point. 0 point. Like that. Then now you can get D2. So D2, it is simply D1, then we subtract. Like that. So that means you check that 0.7771. Then now you subtract. Can you press on the figure? Okay, so now you get that D2. You get the D2. So we can have a short break for the prayers. Then when we come back, we shall finish off that question. We shall be able to finish it off. So that can be okay for that question. Like if backing in a complicate, so you could proceed and finish. You could be able to proceed and finish. So I want us now to check some few questions on the exchange rates. So we can now go to the exchange rates. I want us to view some questions on the exchange rates. You want now to check some few questions on the exchange rates. So there is something I want you to understand first when it comes to the exchange rates. When you go to a bureau to exchange the currencies, there are some prices you normally come across. So that's now where I want us to see how we can go about it. So when you go to the bank tomorrow in the morning, we'll see some two figures, buying and selling. They will be able to give you some prices which are meant to be the buying and the selling. So how do they normally distinguish the buying and the selling? Because they keep on changing. They keep on changing day after day. So we can have those prices determined by the quotation. Those prices may be determined by the quotation. So we need now to come up with the approach, how to go about them. So when you are identifying those prices, we normally have some elements we refer to as the direct quote and indirect quote. We have some cases where we have indirect quote and also the direct quote. That is now what we assist you to identify what should be the selling price and what should be the buying price. So when it comes to indirect quote, we can have something we refer to as indirect quote. So from the explanation point of view, you can see that they can give you some currencies, assuming the Tanzanian currency. We know the Kenyan shilling is stronger than the Tanzanian currency. So you can go there, they have given you, let's say, maybe they have given you 23, let's say 25, then against maybe 27, like that. So they can give you a price like that, 25, then 27. Then they can say one of them is the buying, the other one is the selling. So we are exchanging the Kenyan currency against the Tanzanian currency. So if we are doing that in relation to the example I've given you, it means that these figures they have given you are Tanzanian shillings. So they are exchanging one Kenyan shilling against this or that. So you'll be able to get that part. Now, because we know the Kenyan shilling is stronger. That means the Kenyan shilling is held constant as one against one of them. So at the moment, the home currency or domestic currency is held constant as one. Then the variation is being done in the foreign currency. That will be indirect quote. That will be able to be in direct quote. Then when it comes to the element of the indirect quote, the bank normally buy at a higher price, but it sells at a lower price. So we need now to come up with that particular portion. So when you see these two prices and they are telling you it is Kenyan shilling against the Tanzanian, it means that these figures they have given you, are the Tanzanian shilling, because we know the Kenyan shilling is stronger. So it is the one which is held constant as 1. So these prices are the Tanzanian currency. So one of them is the buying, the other one is what? The selling. So to identify the buying or the selling, you look at it from the bank perspective. So when it is indirect quote, the bank will always be in a position to buy at a higher rate, but sell at a lower rate, because there is a benefit they will get from there. So maybe you can write something brief about indirect quote. Indirect quote. So for the indirect quote, you write that this is where the domestic currency, it is where the domestic currency is held constant as 1. The domestic currency is held constant as 1. It is held constant as 1. And variation is done. And the variation is done in the foreign currency. And variation is done in the foreign currency. And the variation is done in the foreign currency. Then you continue by noting that in the case of indirect quote, in the case of the indirect quote, in the case of the indirect quote, comma, the bank would buy at a higher value. In case of the indirect quote, comma, the bank would buy at a higher value. The bank would buy at a higher value and sell at a lower value. The bank would buy at a higher value and sell at a lower value and sell at a lower value. So that is now what we mean by indirect quote. The other one will be the direct quote. The other one is meant to be the direct quote. The other one is meant to be direct quote. So when it comes to the direct quote, so it will be now the reverse. The foreign currency will be held constant as 1. The domestic is the one which will be changing. So we shall also be able to see on that. So under that, we also note that it is where the foreign currency is held constant. It is where the foreign currency is held constant as 1. It is where the foreign currency is held constant as 1. And variation is done. And the variation is done in the domestic currency. And the variation is done in the domestic currency. The variation is done in the domestic currency. Then we continue by noting that in case of the direct quote, in case of the direct quote, the bank would buy at a lower value. In case of the direct quote, the bank would buy at a lower value and sell at a higher value. The bank would buy at a lower value and sell at a higher value and sell at a higher value. So that's now a brief example of what we can do from that portion. So in the handout we were using, there is one question I want us to do on the handout of the financial derivatives. So kuna swali iko mwisho. There is a question at the end. That will be on page 8. There is a question on page 8 about that element. So that question 1, they are saying that, are you able to see that question 1 at the back of your handout? So the question reads that, suppose a Kenyan bank, a Kenyan company, sorry. Suppose a Kenyan company has exported goods to Tanzania and invoiced the Tanzanian customer. Invoiced the Tanzanian customer, Tanzanian shillings 900 million on a 3-month credit. Other relevant data is shown below. The other relevant data is shown below. So they have given the spot rate, Tanzanian shillings against the Kenyan shillings. Umeona 15.58, 15.62. They have also given you 15.58 and also 15.88. So money market interest rate is given, deposit and also the loan. They now required evaluate the forward market and the money market hedge and recommend on what? On the best option. So first, you can see they are quoting Kenyan shillings against Tanzanian shillings. But we know our Kenyan shilling is stronger than the Tanzanian. So it means the Kenyan shilling is held constant as one. Those figures given are Tanzanian shillings. So that means one of them is the buying, the other one is the selling against one Kenyan shilling. Against one Kenyan shilling. So this one is indirect quote. It is indirect quote because the home currency has been held constant as one. Then variation is being done in the foreign currency. Variation is being done in the foreign currency. So someone may ask, how do I know whether the 15.58 is Tanzania? It is common knowledge, Kenyan shillings against a Tanzanian shillings. Now, you want to exchange rates. Yeah. The Kenyan shilling is stronger than Tanzanian shilling. So if they have given you the exchange between the Kenyan and the Tanzanian, and you see this kind of a figure, it means that the Kenya is the one which is held as one shilling against either 15.58 or 15.62. One of them will be the buying, the other one will be what? The selling. So we have said that this one is indirect quote. It is meant to be indirect quote because the home currency is held as constant as one. Then the foreign currency is the one which is changing. It is the one which is buying and the selling. And we have stated that in case of indirect quote, the bank will buy at what? What you have just written in your notes. In case of indirect quote, the bank will buy at a higher. So which means the higher values are the buying price. You see the higher values, you indicate them as the buying price. The lower ones will be the selling price. So those ones which are given, like now the first one, it is 15.58 against 15.6. So 15.62 is the buying rate, isn't it? And 15.58 will be the selling rate because it is in direct quote. Then again, so this person will be given Tanzanian shillings. You are in Kenya and you have been given what? Tanzania. So in Kenya, we don't use Tanzanian shillings. You will be forced to convert them into Kenyan. So you will go to the bank. You will go to the bank to sell. So you are going to sell. Now, you have been given Tanzanian shillings. So you require Kenyan. So you go to the bank. When you go to the bank, you will be going to sell. And therefore the bank will be buying. The bank will be buying that money from you. Because you are the one with the problem. So your personal. So you go with the money to the bank to exchange. So when you take it to the bank, you are going to sell that money to the bank. And therefore the bank will be buying. And the quote is from the bank perspective. So it will be buying at a higher price from you. So you are the one with a problem. You have Tanzanian shillings in your pocket. So you require the Kenya. So you go to the bank. So if I go to the bank, it means I'm going to sell. Yeah. It is your animal, you have taken it to the market. Once you take it to the market, it means you are going to do what? To sell. So the person in the market will be doing what? Will be buying from you. So now in case of indirect quote, they will be buying from you at a higher price. So now they have talked about money market and the forward market. So forward market, it is simply where they quote a price in the future. The forward market, it is simply where they quote the price in the future. Like now for this one, it is 3 months forward. You see it is 3 months forward. Then what happens in the money market when it comes now to the money market? I just want to give a brief explanation about what happens in the money market. So this person is in Kenya. The customer is where? In Tanzania. So he's supposed to be paid. You have supplied goods to the customer in Tanzania, but he will pay you after 3 months. He will be paying you after 3 months. So in the money market, don't wait for the 3 months to be paid. You go to the customer's bank in Tanzania. Then you use that customer as security in Tanzania. You borrow money from the bank in Tanzania, using your customer there as your security. So the money will be given by the bank, you convert it into the Kenyan shillings. Then you also come and deposit in the Kenyan bank to earn you some interest for the 3 months. So after 3 months, your customer will pay your loan in Tanzania. Then now you compare the money you have in Kenya. By that 3 months, it will have grown up to how much? But the money you borrow in Tanzania should be, after 3 months, is when it will increase to, like now this one, 900. So you borrow less, plus interest. Now it will grow to 900. So that the customer now clears that loan in Tanzania. Then you come with the money in Kenya. So for those 3 months, you can put on a fixed deposit account. Then you wait for 3 months. It will have grown to how much? Then we compare. If it will be more than what you will have paid or what you will have received, then you go for the money market. If it is less, go to the forward market. We shall be able to compare them from that portion. So that's now a simple explanation, but we shall get to now when we do the question. So let us now go to the question. Let us now go to the question. So in the question, we can first note that this is indirect quote. It is indirect quote. It is indirect quote. Since the domestic currency is held constant, the domestic currency is held constant as 1. The domestic currency is held constant as 1, and the foreign currency is changing. And the foreign currency is changing. The foreign currency is changing to identify the buying and the selling price. This is changing to identify the buying and the selling price. To identify the buying and the selling price. Then you continue by noting that in case of indirect quote, the bank buys at a higher rate. In case of indirect quote, the bank will buy at a higher rate and sell at a lower rate. It will buy at a higher rate and sell at a lower rate. And sell at a lower rate. Then a new paragraph, note that in this case, the Kenyan exporter, would receive Tanzanian shillings. The Kenyan exporter would receive Tanzanian shillings. Would receive the Tanzanian shillings, which he will sell to the bank. Which he would sell to the bank. And therefore the bank will buy, which he would sell to the bank, and therefore the bank will buy. The bank will buy at a higher rate. The bank will buy at a higher rate. Yeah. So let us now go to the forward market. What will he be receiving in the forward market? So we start off with the forward market. We start off with the forward market. We start off with the forward market. So forward market, you can see in the question the 3-month forward. The question has given me some 3-month forward. You see the 3-month forward. The exchange rate in the 3-month forward, are you able to see 15.58? Then also 15.58. 88. But we have said that you will sell to the bank and therefore the bank will buy, isn't it? So it buys at what price? A higher rate. So, yeah, so that means it is 15 point what? Yeah, so the exchange rate will be 1 Kenyan shilling will be equivalent to 15.88 Tanzanian shillings. We agree on that? Because you have already explained that it was in direct quote. Then you have been given Tanzanian shillings, which you don't require in Kenya. It means you are going to sell to the bank. And therefore the bank will be buying from you at a higher rate. So you want now to know the bank will give you how much in the forward market. So this is now the exchange rate. 1 Kenyan shilling will be equivalent to 15.88 Tanzanian shillings. But this person has given you how much Tanzanian shillings? So it is 900 million Tanzanian shillings. So can you now cross multiply so that we get the money you would receive in the forward market? So that we get the money you will receive in the forward market. So in the forward market, it will now be 900 millions multiplied by 1 divided by 15.88 divided by the 15.88. So that is now in the forward market. That is now what is there in the forward market. That is now what will be there in the forward market. Atapata pesa ngapi in the forward market? 56, 675 what? Yeah, so you already, that's the forward market. Let us now go to the money market. Let us now go to the money market. So when it comes to the money market, I have explained that you don't have to wait for the 3 months to do it, to be paid. You go to Tanzania, you go to the bank of your customer, you present your customer as the security, then you borrow from there. That money, you convert it into the Kenyan shillings, then come and deposit in Kenya for 3 months. And by 3 months, you compare to have gone to how much. So let us now start to work for the money market. So when it comes to the money market, when you check in the handout, they will tell you we normally use the matching principle. We normally use the matching principle where for every current assets, you create a current liability. For every current asset, you create a current liability by borrowing. So this one is a current asset because someone is paying it. Now you are being paid the 900. So those are receivables, they are debtors. So you create a current liability by borrowing. That's now the corresponding. But it is there in the notes. If you go through that information given, you will see those details. So our first step is to borrow. To borrow in Tanzania. So your customer is in Tanzania. So our first step is borrow in Tanzania. Our first step will be to borrow in Tanzania. So you want to know the amount you borrow. So amount to be borrowed will be the same as the present value. So it will be given by the future value divided by 1 plus R. So amount to be borrowed is the same as the present value. That present value will be given by the future value. We divide by 1 plus R. So he is borrowing in Tanzania. I want you to check in the question the loan rate in Tanzania. Are you able to see the loan rate in Tanzania? Wamewapea which percent? It is 9%. It is 9%. But we are borrowing for how many months? 3 months. So R for 3 months R for 3 months, you take 3/12 multiplied by 9. We are borrowing that money in Tanzania, and the interest rate in Tanzania on the loans, it is 9%. And that 9% is per annum. So we convert it for the 3 months. So it will pay which percent? 2.25%. So now we come at this point, the amount to borrow. So that money after 3 months was 900,000 millions. Then 1 plus R. So now R is the 2.25, which is the same as 0.02225. So that's now the amount to be borrowed. That now should be the amount to be borrowed. That is now the amount to be borrowed. That now should be the amount to be borrowed. So at a borrow, how much? Sorry? 800 and then 195, 599. So that's now the amount to be borrowed. So once he has borrowed, now you go to the step number 2. Step number 2, convert into the Kenyan shillings. Step number 2 will be that convert into Kenyan shillings. So you convert at the spot rate. At the spot rate. You convert it at the spot rate into the Kenyan shillings. So the spot rate, now go to the spot rate. The spot rate, we have 15.58 and 15.62. So we have said that it is indirect quote, isn't it? So where utapewa hii pesa ya Tanzania? Sasa unaleta Kenya. So kuja Kenya utaenda kwa bank kuuza. So the bank is buying, isn't it? So it is buying at a higher rate. So the exchange rate will be 1 Kenyan shilling is equivalent to 15 point what? 15.62 Tanzanian shillings. You can see the spot rate. The spot rate is 15.58 under 15.62. So the bank is buying. When it buys at a higher rate. So you pick the higher rate. Then now we already know the money in Tanzania. It is 880, 195, 599, like that. So convert it into the Kenyan shillings. It will be equivalent to how much? Inakuwa ngapi? 56, 350, 5, like that. 56, 350, 551. Yeah, so your pesa ukisha convert, now you got the step number 3. You deposit in the Kenyan bank for 3 months. So now deposit in the Kenyan bank for 3 months. Deposit in the Kenyan bank for 3 months. So deposit in the Kenyan bank for 3 months. So step number 3 is that deposit. Deposit in Kenyan bank for 3 months. So we deposit that money in the Kenyan bank for 3 months. So we look for the future value. So future value will now be the present value 1 plus R. We now deposit in the Kenyan bank for 3 months. So we look now for the future value. So I want you to check in the question, deposit rate in Kenya. What is the deposit rate in Kenya? It is 5%. So you are depositing there for 3 months. So it is 3 over 12 multiplied by 5. So itakuwa which percent? Inakuwa 1.25%. So it will be 1.25%. So now we come here to get the future value of that money. So it is 56,350, then 551. Then 1 plus 0.0125. So now you get that money in Kenyan shillings after 3 months. You now get that money in terms of the Kenyan shillings for the 3 months. Your 3 months is our pair which year? Sorry? Sorry? 933. So you want now to compare them. So at this point, you after 3 months, you have this money. But your customer in Tanzania after 3 months, he will pay your loan in Tanzania. So own obligation in Tanzania. Because the bank gave you the money to come and invest in Kenya. But your customer, after 3 months, he clears your loan. So you have no intention on that now on that loan. So now you want to compare here money market and forward market. Which one will you receive more when you compare the amount you are getting in the money market against the one in the forward market? Where are you receiving more? Yeah, so now you advise that investor that select the money market. You select the money market. Select the money market, since this is where the investor will receive more. You select the money market, since this is where the investor will receive more, since it is where the investor will receive more. So that's now one of the questions you are to apply. So I will pick now some questions from your past papers. I want us now to pick some questions from your past papers. So we can start with the one. We can start with the one for the sitting of May 2018. May 2018, there is a question number 5, part C. May 2018, there is a question number 5, part C. It is there on page 41. It is there on page 41. So on page 41, there is a question number 5, part C. There is a question number 5, part C. So that question 5, part C, are you able to see on page 41, where they explained about Kikumi Limited? Expect to receive how much? 750,000 euros from the credit customer in the European Union. In how many months? In 6 months time. Then spot exchange rate, to pay us 2.349 euros. against $1. So the exchange rate there is 2.349 euros against $1. And the 6-month forward, it is 2.412 against $1. So this time your concept here, direct or indirect, does not apply because when you compare to one figure. Like the previous question, you have to identify the buying and the selling. But now this one, that concept will not apply because they have only given you one figure. They have only given you one figure. So when you continue on the same, they say that the following commercial interest rates are available to Kikumi Limited. Deposit rate per annum is given. Borrowing rate also per annum is also given. In the euro, that is the European Union, and also in what? In the US. So Kikumi Limited does not have any surplus cash to use in hedging in the future euro receipts. So now required, evaluate whether money market hedge or forward hedge will be what? Preferred. So we start with the forward market. We start off with the forward market. We start off with the forward market. So we start off with the forward market. We start off with the forward market. So in the forward market, we start with the forward market. In the forward market. So in the forward market, the question gave you the 6-month forward exchange rate. Naona hiyo 6-month forward exchange rate. Tumepewa 2.412. You can see 2.412 euros. Mnajua sign ya euro? Nasomanga paper every day. Nasomanga nini kwa newspaper na mali pa forex exchange. Ama mjaya angalia. You are never interested on that. You can make money out of it. If you are interested in it, you can start by making money from it. When I teach to discuss about triangle arbitrage and the locational arbitrage. But for now, let us concentrate on this part. So the euro will normally present it in that manner. Against $1. Against $1. So that's now the forward market. So this person was to receive how much euros? Yeah, so alikuwa anapata 750,000 euros. So mukiconvert into the US dollars atapata pesa ngapi? So when you convert it into the US dollars, you will be able to receive how much? Atapata ngapi? Sorry. 310. 945 US dollars. So that's now in the forward market. That is the money you receive in the forward market. So now after that, we go to the money market. After that, we now go to the money market. We now check the one for the money market. So when it comes to the money market, I have said this person is in the US, but his customer is in the European Union. Yeah. So the person has given him the euros. The person has given him the euros. So when it comes to the money market, when it comes to the money market. So instead of him waiting for 6 months to be paid, he will go to the European Union atumie huyo customer wake kama security to borrow. So you want to know the amount to be borrowed. So the first step will be amount to be borrowed. Amount to be borrowed. Amount to be borrowed. So amount to be borrowed, we say it is the present value. It is the future value divided by 1 plus R. It is the future value divided by 1 plus R. So I want you to go to the European Union. Are you able to see the European Union under the commercial interest rate? That is the euro. European Union, are you able to see the borrowing rate per annum? Wamekupea which percent? Yeah, so R will be 6 months divided by 12 months multiplied by 8. So R will be in a prepare which percent? So we get 4%. So now tunatafuta the amount we borrowed. So that money was how much? 750,000. We divide by 1 plus R. So R is the 4%, which is the same as 0.04. So you have your amount at a borrow. That is now the amount you will be able to borrow. And someone 700 and what? 721. 154 like that. Then the second step, he converts that money into the US dollars. So the second step will be convert into US dollars at the spot rate. At the spot rate. You convert into the US dollars at the spot rate. Are you able to see that in the question the spot exchange rate? I'm at to pay at 2.349 euros is equivalent to 1 US dollar. Is equivalent to 1 US dollar. So those euros, there are 721, 154. So when you convert them into the US dollars, atapata ngapi? 307, 005. Then now you go to the step number 3. He now deposits the money in the US for 6 months. He now deposits the money in the US for the 6 months. So now we say deposit the money in the US for the 6 months. So deposit the money in the US for the 6 months. So we now see that deposit the money in US. Deposit in US for 6 months. That means we look for the future value. So future value is the present value 1 plus R. So confirm R in the US. That is now for the deposit. So R in the US will be 6/12. Then what have you been given us? The interest rate on the deposit in the US? I'm going to pay 2%. So it will be 6/12 multiplied by 2. And I'll pay 1%. So that now will be equivalent to 1%. Now it is equivalent to 1%. Yeah. Then the future value for that month. So it is 307. Then 1 plus. Here it is 0.01. You part your future value. You part that future value. Itakuja ngapi hiyo? Nataka to compare the money market and the forward market. You select the forward. Yeah, so now we advise the investor to select the forward market. So select the forward market because you will receive more. You select the forward market because you will receive more. You select the forward market because you will be able to receive more. So, kesho mko na class. Mwalimu alimaliza. Nauliza kama mwalimu alimaliza ama bado mnampa class kesho. Okay. Sasa tutamalizia lini? Hiyo inawatosha kufanya some other questions. So we meet tunapanga na class on Saturday. Kama mko na class kesho, I have no option for tomorrow. During the day, start to inconvenience anyone on Fridays. Tomorrow is a Friday. Start to interfere the rights here. No. I know some people will be offended. So Saturday. Sorry. Nataka kufanya nikianza kufanya mtaanza kushika kichwa hiki. Mstaki mfanye kichwa hiki. It's better you do it when you are afraid. See, mmeelewa? Yeah. Mimi nimesema I don't want to offend anyone. I want time which is free for everyone. Asio mtu ana raise alarm. Which is normally the normal your normal class. Education na class we can have it on Saturday. Sitafanya maswali mengi, tafanya tu kama hii nimefanya leo. Na itahitaji atukimaliza uende usome. Hii sasa utaenda kusoma sana. So just to check what you have done. Yeah, so it is just 2 hours yenye natafuta kutoka kwenu. Na sio a must nipate hizo hours. Kama mnaona mko sawa, mnaweza baki hivyo. Mimi najua on Friday or hiyo Saturday unless tupatane from mwalimu atakuwa tena 11 Saturday. Mko na maana kwanga na leadership on Saturday. Sorry? My only challenge, kuna watu wenye hawako hapo online. Na your schedule of working, siwezi nikajua how you work. Mimi nataka tu ile time inakuanga for evening class. Because evening class, weekdays, naanzanga 6 to 8. Isn't it jioni? Saturday mnakuanga nayo from 8 to 4. Hiyo ndio time kwa schedule for me. So I want that kind of the time. You will see interfere with anyone's life. But Friday is only one, which is tomorrow. Na mnaniambia mko na leadership. I'm saying only 2 hours. Start more time.
8 to 11.
So you have tax at what time on Saturday? Those who say they have a class on Saturday. Yeah, sasa hiyo time kuna mtu anasema ako na tax. Yes, kuna mtu anasema ako hii class na anafanya tax during that time. Hiyo Saturday yenye mna propose asubuhi. Yes, kuna mtu hata ana combine. Yes. All of them. Maybe afanye FAR. Si kuna watu wanafanya refers. There are people are doing refers. So kuna mtu anaweza fanya refer ya tax na FM. So let us make a conclusion. Tutapatana tu hiyo Saturday saa 8. Saturday saa 8 ama 11. But 11 kama mwalimu hata kwa amemaliza leadership, siwezi nikaitafia. Yeah, si kesho mko na leadership. Na Saturday 11 to 1 mnakuanga na leadership, ndio. Kama atamaliza then tutafanya hiyo Saturday. Hiyo ya 11 to 1. Sitakuja hapa Sunday. Anyone talking about Sunday? Sunday nitawaachia mkram kufanya mtihani on Monday. Yeah, then also this Sunday twende tuombe. Tuombe Mungu atusaidie. Yeah. What the only problem I have, staki mtu analilia machozi. Aseme ni schedule class outside. They are saying, they are communicating on all their comments. So I cannot interfere with someone's right. Because ataniambia alilipa school fees na hii ndio time alikuwa schedule. That is the hata anaweza nipeleka kotini. Anasema class yake ilikuwa saa 8 on Saturday. Sorry? Kuna prayers kesho saa 8 for the school. Wameweka, I suspect wameweka, maybe. So we have agreed we shall meet on Saturday afternoon. Tunakubaliana hiyo. So we meet on Saturday at 2. But kama mwalimu atakuwa amemaliza leadership, nita confirm tutapatana on Saturday at 11. Hiyo time wanakuanga na leadership. So, yeah. But kama hatakuwa amemaliza, then tutapatana saa 8. So it will be confirmed. It will be confirmed tomorrow. Na nyinyi hata mtaconfirm. Mseme kama mwalimu atamaliza kesho leadership, then you be sure that we have a class on Saturday at 11. But kama hatakuwa amemaliza, we meet at 2. So we stop there. Taongea the last minute so that you don't. Taongea ile ya mwisho.